Silver hit $121.62 on January 29th, 2026, an all-time high that shattered every record in the metal's history. Then, in less than 72 hours, it dropped $12 from 121 to 108. A 10% pullback that has traders asking one question. Is this the crash, or is this the last chance to buy before 150? Because here's what you need to understand. Silver just completed the most explosive rally in modern financial history. 279% gain in 2025, another 70% in just the first month of 2026. The metal went from $30 to $121 in 13 months. And now, after hitting that peak, we're watching the first real test of this bull market's foundation. The bears are screaming bubble. They're pointing to the Hunt brothers' collapse in 1980. They're warning about vertical rallies that always end in tears. They're calling this the top. But the bulls see something different. They see a healthy correction in a market that's barely begun. They see physical supply that's still draining. They see industrial demand that's still accelerating. They see a $12 dip in a metal that just gained $91. And here's the critical part that most people are missing. The mechanics behind this pullback are completely different from what happened in 1980. The fundamentals are different. The supply situation is different. The demand structure is different. And the catalyst that could send silver to 150 is already in motion. Over the next 40 minutes, I'm going to break down exactly what happened. The precise technical levels that matter. The three scenarios that could play out from here, the data showing whether this is distribution or accumulation, and the timeline for when we'll know if 108 was the bottom or just a pit stop on the way lower. This isn't speculation. This is analyzing the largest move in silver's history and understanding whether the bull run that took it from 30 to 121 is over, or whether we're about to watch phase 2. The all-time high is $121.62. The current price is bouncing around 108 to 112. And the next 30 days will determine whether silver holders celebrate or capitulate. Let me show you exactly what's happening. To understand whether this $12 drop is normal or catastrophic, you have to look at the path silver took to get to 121. Because the rally that brought us here was not gradual, it was explosive. And explosive rallies always retrace. January to 2025, silver opened the year at $30. The metal had spent years trading in a range between 22 and 30. Investors were tired. The silver bugs who had been calling for $50 since 2011 had mostly given up. The consensus was that silver was dead money. Then October 2025 arrived. Silver broke through $49.95. That was the old high from 1980. For 45 years, that level had been the ceiling. Every time silver approached it, sellers materialized. The market remembered what happened after the Hunt brothers pushed it to 50. It crashed 90%, so traders treated 50 as radioactive. But in October 2025, something changed. The metal didn't just touch 50, it blew through it, and it didn't come back. That breakout told the market that this time was structurally different. From October through December, silver consolidated between 50 and 70. It wasn't a straight lineup. There were pullbacks, there were shakeouts, but every dip got bought. The $50 level that used to be resistance became support. This is textbook bull market behavior. Old resistance becomes new support. Then January 2026 hit, and the parabolic phase began. Silver went from 70 to 90 in 10 days, then 90 to 110 in another week, then 110 to 121 in 48 hours. The final push to the all-time high was nearly vertical. Vertical moves don't sustain. They can't. Markets need to breathe. When something goes straight up without consolidation, it builds up energy that has to release. That release is called a pullback, and that's exactly what we're seeing now. On January 29th, silver touched $121.62 intraday. Then it reversed. Hard. Within 4 hours, the metal had dropped 13% to $102.52. Traders who were celebrating all-time highs at breakfast were underwater by dinner. The speed of the move shocked everyone. But here's the part that's critical. The pullback found support. At 102, buyers stepped in. The metal recovered to 112 by the next day. As of January 30th, silver is trading around 108 to 110, depending on the session. That's a 10% correction from the highs. Now, let's put that in context. Silver rallied $91 from 30 to 121. A 10% pullback means giving back about $12 of that $91 move. That's 13% of the total gain. In a market that went vertical, a 13% retracement is not just healthy, it's mandatory. Look at every major bull market in history. They don't go straight up. They advance, they pull back, they consolidate, they advance again. The pullbacks shake out weak hands. They allow new buyers to enter, they reset momentum indicators, and they build the base for the next leg higher. The question isn't whether silver should pull back. The question is how far it pulls back and whether it holds the critical support levels. Because if those levels hold, this is a correction. If they break, this becomes distribution. Right now, the market is testing those levels, and the data coming in over the next few weeks will tell us everything we need to know. The first thing you need to understand about this pullback is that it wasn't driven by fundamentals. Nothing changed in the physical market. The supply deficit is still there. Industrial demand is still rising. Central banks are still buying. The structural drivers that took silver from 30 to 121 didn't reverse overnight. What changed was sentiment, and in markets, sentiment can turn on a dime. Let's walk through what actually happened. On January 26th, silver hit $117 intraday. It consolidated there for a day. Then on January 29th, it made one more push. The metal touched $121.62. That's the exact high. At that moment, something happened. Large institutional holders started selling. We know this because the volume spiked. Heavy volume on a reversal from all-time highs is a red flag. It means big money is exiting. Why would institutions sell at all-time highs? That's simple. Profit taking. Think about it. If you bought silver at $50 and it just hit 121, you're sitting on a 142% gain. At some point, you lock in profits. You don't care if it goes to 150 tomorrow. You care about securing the gain you already have. This is especially true for institutions that manage quarterly performance. If you're a fund manager who bought silver in Q4 2025 and you're up 100% in Q1 2026, you sell. You book the win. You show your investors a massive return, you reduce risk, and you wait for the next entry point. That selling triggered stop losses. When silver dropped below 115, automated sell orders kicked in. Traders who had bought at 110 with stops at 114 got stopped out. Their forced selling pushed the price to 110. That triggered the next layer of stops, and so on. This is called a cascading liquidation. It's mechanical. It's not about fundamentals. It's about leverage and risk management. And it's brutal. But here's the key. Cascading liquidations end when they run out of sellers. And around 102, the sellers ran out. Why? Because at 102, the metal was back to where it had been just a week earlier. Buyers who missed the move from 100 to 121 saw 102 as a gift. They stepped in hard. The recovery from 102 to 112 in one day tells you the bid was strong. This wasn't weak buying. This was aggressive accumulation. Someone wanted that metal at 102. They didn't care that it might go to 95. They bought size. And that brings us to where we are now. 108 to 112. The market is consolidating. It's trying to find equilibrium between the bulls who see a dip to buy and the bears who see a top to short. Now let's talk about what this looks like technically, because the charts are screaming two different stories depending on which time frame you're watching. On the daily chart, this looks like a disaster. Silver peaked at 121, crashed to 102, and is now grinding sideways around 110. If you only looked at the last week, you'd think the bull market is over. But zoom out to the weekly chart. Silver spent all of 2024 building a base between 22 and 32. It spent Q1 2025 consolidating between 30 and 35. Then it broke out in October. The move from 50 to 121 is a single vertical push on the weekly chart, and the pullback to 108 is just the first candle after that push. In technical analysis, this is called a flagpole and flag pattern. The vertical move is the pole, the consolidation after the move is the flag. And historically, flags resolve in the direction of the prior move. That means after consolidation, the metal should continue higher. But that's only if the support holds. So let's identify the levels that matter. The most critical support is $99. Why 99? Because that's the ascending trend line from the January lows. Silver has been trading in a rising channel since January 8th. The bottom of that channel is currently at 99. As long as silver holds above 99, the short-term uptrend is intact. If 99 breaks, the next support is $92. That's where the 20-day moving average is sitting. It's also close to the highs from mid-January before the final parabolic push. A drop to 92 would be a 24% correction from the highs. That's deeper than the current 10%, but it's still within the range of healthy corrections in bull markets. Below 92, the next level is 87. That's psychological. It's also roughly where the breakout from 3 digits to triple digits occurred. Holding 87 would keep the narrative intact that silver is a triple-digit asset now. If 87 fails, we're looking at 75 to 80. And at that point, the bull case is in serious trouble. Not dead, but wounded. Because a 35% correction from the highs starts to look less like consolidation and more like distribution. On the resistance side, the first level is 115. That's where the selling started on the way down. If silver can reclaim 115, it sends a message that the dip is over. The next resistance is 121 to 122. That's the old high. Clearing that level on volume would suggest the metal is ready for price discovery above 125. Right now at 108 to 110, silver is sitting in no man's land. It's above the critical 99 support, but it's below the 115 resistance. This is the zone where the market is deciding. And here's what the indicators are telling us. RSI on the daily chart is at 45. That's neutral. It's not oversold, it's not overbought, it's dead center. That tells you the momentum from the rally has been washed out, but there's no bearish momentum building yet. The market is in limbo. MACD is starting to curl down. That's a warning sign. If MACD crosses below the signal line, it would confirm bearish momentum. But it hasn't crossed yet. It's hovering. Volume is the tell. On the drop from 121 to 102, volume was massive. That's expected. Panic creates volume. But on the recovery from 102 to 112, volume was also strong. That's bullish. It means buyers are committed. They're not just bottom fishing. They're building positions. So technically, the picture is mixed. The market is testing support, the indicators are neutral, and the price action is consolidating. This is exactly what you'd expect after a vertical move. The question is whether consolidation leads to continuation or reversal. The bear case is straightforward. Silver went too far too fast. The rally from 30 to 121 was driven by speculation, not fundamentals. And now reality is setting in. Bears point to the Hunt brothers. In 1980, Nelson and William Hunt tried to corner the silver market. They bought 200 million ounces. The price went from $6 to $50 in 18 months. Then the COMEX changed the rules. They implemented Silver Rule 7, which restricted margin buying. The Hunt brothers got margin called. They were forced to sell. The price collapsed to $10 within weeks, a 90% crash. The bears say we're seeing the same pattern, a speculative mania that pushed silver vertical, and now the mania is ending. They argue that once the euphoria fades, there's nothing holding the price up. The metal will give back most of the gains. They also point to the gold to silver ratio. At the peak, the ratio hit 45 to 1. That's the lowest it's been in 14 years. Historically, when the ratio gets that low, it means silver is overextended relative to gold. It needs to correct, and they're watching the dollar. If the dollar strengthens, that's typically bearish for commodities. The dollar index has been weak, which helps silver's rally. But if the dollar bounces, silver could face headwinds. The bears also worry about a recession. If the global economy slows, industrial demand for silver falls. And since 60% of silver demand comes from industrial uses, a recession would be devastating. Finally, they point to positioning. Speculative long positions in silver futures hit record levels in January. When everyone is long, there's no one left to buy. That's a contrarian sell signal. The market is overcrowded on the long side, which makes it vulnerable to a sharp reversal. Put it all together, and the bear case says this: silver rallied too far on speculation. The fundamentals don't support 121. The correction to 108 is just the beginning. The metal is going back to 80, maybe 70, maybe lower. This was a blow-off top, and anyone holding silver at 108 is going to regret it. That's the bear case. It's logical, it's grounded in historical precedent, and it's worth considering. But the bulls have a completely different interpretation, and their case is just as compelling. The bull case starts with one fact. The supply situation in 2026 is nothing like 1980. In 1980, there was plenty of silver. The market was liquid. The Hunt brothers created an artificial shortage through hoarding, but once they were forced to sell, supply flooded back. The price collapsed because there was no physical shortage. 2026 is different. The physical market is in deficit. For the 6th consecutive year, global silver consumption exceeds mine production. The Silver Institute estimates a deficit of 170 million ounces annually. That's structural. It's not speculation. It's actual supply and demand. And the deficit is getting worse. Solar panel production is accelerating. Each panel requires silver paste for conductivity. In 2024, solar demand consumed 16% of global silver supply. In 2025, it was 18%. In 2026, it's projected to hit 20%. That's 200 million ounces going into solar, and it's not coming back. It's embedded in panels that will sit on rooftops for 25 years. Electric vehicles are another massive sink. EVs use 3 times more silver than internal combustion cars. Every vehicle has silver in circuit boards, contacts, and sensors. Global EV production is doubling every 2 years. That's exponential growth in silver demand from a sector that didn't exist a decade ago. Then there's AI in data centers. Semiconductors require silver. Every chip, every server, every data center is silver intensive. And the AI boom isn't slowing down, it's accelerating. And it's pulling silver out of the market at a pace that miners can't match. Bulls also point to China's export restrictions. On January 1st, 2026, China tightened controls on silver exports. China is the world's largest refiner. If they restrict exports, Western markets lose access to processed metal. That creates a bottleneck. And bottlenecks cause price spikes. The United States responded by adding silver to the critical minerals list. That's the government saying silver is strategic. When governments declare materials critical, it signals long-term demand support. It also means policy will favor domestic production and stockpiling. On the demand side, ETF inflows are accelerating. The iShares Silver Trust saw $40 billion in turnover on January 26th. That's the same level as the S&P 500 ETF. Retail investors are pouring into silver because gold is too expensive. At $5,500, gold is out of reach for average investors. But at $108, silver is accessible. And as gold keeps rising, silver gets more inflows as a substitute. Central banks are diversifying into silver, not at the scale of gold, but they're buying. When central banks buy an asset, it validates that asset as a monetary hedge. Silver is regaining its role as money, not just commodity. The bulls also argue that the technical picture supports higher prices. Silver broke a 45-year resistance at 50. That's generational. When an asset breaks a multi-decade resistance, it doesn't just pull back to the breakout and die. It consolidates and continues. The measured move from the $50 breakout projects, a target of $150. How do you get that? Take the range of the consolidation before the breakout. Silver traded between 20 and 50 for years. That's a $30 range. Add 30 to the breakout point of 50, and you get 80. We've already exceeded that. But if you apply the next extension using Fibonacci levels, the 161.8% extension of that range lands around 145 to 155. That's why bulls are targeting 150. And finally, bulls point to sentiment. Yes, positioning is extended. Yes, everyone is long. But that's what happens in the early stages of a mania. The real mania hasn't started yet. The real mania is when your neighbors are talking about silver at dinner parties, when billboards advertise silver coins, when late-night TV has silver infomercials. We're not there yet. The bulls say this: silver went from 30 to 121 on fundamentals. The pullback to 108 is healthy. The supply deficit is real. The demand growth is real, and the rally is nowhere near over. The target is 150, maybe 200. This is the beginning of a supercycle, not the end. So there you have it. Two completely different interpretations of the same price action. The bears see a top, the bulls see a dip. And both sides have data to support their view, which brings us to the most important question. How do we know which scenario is right? The answer is we watch the next 30 days very closely, because the market is about to tell us which narrative wins. The most important data point is support. If silver holds above 99, the bulls control the narrative. Every test of 99 that holds is another confirmation that buyers are defending the uptrend. As long as 99 holds, the door to 150 is open. If 99 breaks, we're going to 92. And at 92, the market decides again. If 92 holds, it's still a correction. If 92 breaks, we're probably going to 87. And if 87 fails, the bear case is gaining credibility. On the upside, we're watching 115. If silver can reclaim 115 in the next 2 weeks, it signals that the correction is over. A move above 115 would set up a retest of 121. And if 121 breaks on the second attempt, we're in price discovery. There's no resistance above 121 except psychological levels like 125, 130, 140, and 150. The second thing we're watching is volume. On any bounce, we need to see strong volume. Volume confirms commitment. If silver bounces to 115 on light volume, it's a weak rally. It'll fail. But if it bounces to 115 on heavy volume, it means institutions are buying. That's bullish. The third thing is gold. Silver follows gold. If gold continues to 6,000, silver will follow. But if gold starts to roll over, silver is in trouble. Fourth, we're watching the dollar. A weak dollar is bullish for commodities. The dollar index is at multi-year lows around 100. If it breaks below 99, that's fuel for silver. But if the dollar reverses and rallies to 103, that's a headwind. Fifth, we're watching Shanghai premiums. In late January, Shanghai was paying $10 over the London price. That's a sign of tight physical supply in Asia. If those premiums persist, it confirms the supply deficit story. If they collapse, it means demand is fading. And finally, we're watching the calendar. February is typically a weak month for commodities. Traders call it the February fade. If silver can hold 99 through February, it sets up for a March rally. But if it breaks support in February, we could see a deeper correction into March or April before the next leg up. The timeline is clear. The next 30 days will determine whether 108 was the low or just a stop on the way to 92. And the next 60 days will determine whether this bull market has legs to reach 150 or whether we're topping out. Let's run through 3 scenarios: high, medium, and low probability. Each scenario has a different outcome, a different timeline, and a different set of triggers. Scenario 1 is the bull case. Silver consolidates between 105 and 115 for the next 2 to 3 weeks. It tests 99 once or twice, but holds. Volume stays firm on any dips. By late February, the market confirms that 102 was the low. In early March, silver breaks back above 115. By mid-March, it retests 121, and by April, it's trading at 135 to 145. This scenario requires three things. First, gold has to stay strong. If gold pushes to 6,000, silver follows. Second, physical demand has to stay robust. If Shanghai premiums stay elevated and COMEX inventories keep draining, the supply story stays intact. Third, the dollar has to stay weak. If the dollar breaks below 99, commodities catch a bid. If all three of those conditions hold, silver is at 150 by Q2 2026. That's the bull case. Probability, 40%. Scenario 2 is the base case. Silver grinds sideways for the next month or two. It trades in a range between 100 and 115. It doesn't make new highs, but it doesn't crash either. The market digests the rally. Speculators get flushed out. Long-term holders accumulate on dips. By Q2, silver has built a base around 105 to 110. From there, it makes another attempt at the highs. This scenario assumes mixed signals. Gold stays range-bound between 5,000 and 5,500. The dollar stays range-bound between 100 and 103. Physical demand stays firm but doesn't accelerate. The market needs time to consolidate. In this scenario, silver reaches 130 to 140 by year end, but it takes longer. It's a grind, not a melt-up. And there are plenty of shakeouts along the way. Probability, 45%. Scenario 3 is the bear case. Silver breaks 99 in the next week or two. It drops to 92. Buyers step in, but the bounce is weak. It fails at 105. The metal rolls over again and drops to 87. By that point, the narrative shifts. The media starts calling it a bubble that popped. Retail investors panic and sell. Silver grinds down to 75 over the next few months. This scenario requires a fundamental shift. Either gold collapses below 4,500, signaling a broader risk-off move, or the dollar surges above 105, crushing commodities across the board, or a recession hits and industrial demand craters, or China opens the export floodgates and physical supply surges. In this scenario, silver finds support somewhere between 70 and 80. It stabilizes there for the rest of 2026. The bull market isn't dead, but it's on pause. The next leg up doesn't come until 2027. Probability, 15%. Three scenarios. Bull case, 150 by Q2. Base case, consolidation followed by a grind to 130 by year end. Bear case, a drop to 75 to 80 with a multi-month bottom. The market is about to tell us which one we're in. Now let's talk about what this means for anyone holding silver or thinking about buying. If you bought silver at 30 and you're sitting on a triple, you're in a different position than someone who bought at 115 and is now underwater. So let's address both. For long-term holders who bought below 70, this pullback is noise. You're still massively in profit. The question is whether you take some off the table or hold for higher prices. The answer depends on your time frame. If you believe the bull market is going to 150 or higher, you don't sell at 108. You hold. You might trim 10 to 20% to lock in some gains, but you don't exit the core position. If you bought between 70 and 100, you're still in profit, but the volatility is uncomfortable. The best strategy here is to set a mental stop. If silver breaks 92, you might consider reducing exposure. But as long as it holds above 92, you stay long. If you bought above 110, you're underwater. That's painful. The question is whether you average down or cut the loss. The honest answer is it depends on your conviction. If you believe the bull case, you average down around 105. You lower your cost basis. If you don't have strong conviction, you wait. You don't add to a losing position without a plan. For new buyers, the opportunity is now. If you missed the rally from 30 to 1 in 21, this pullback is your entry. The risk reward is favorable. If silver goes to 150, you're making 40% from 108. If it goes to 92, you're down 15%. That's a 2.6 to 1 reward to risk ratio. That's acceptable. The strategy is to scale in. Don't go all in at 108. Buy a third of your position at 108. If it drops to 105, buy another third. If it drops to 100, buy the final third. That way, you're averaging into the position rather than trying to pick the exact bottom. And for anyone considering shorting silver, be very careful. Shorting a market that's up 300% in a year is dangerous. The trend is still up on the weekly chart. The fundamentals are still supportive, and if you're wrong, the losses can be catastrophic. Only short with tight stops, and only if you're an experienced trader. The key takeaway is this. The pullback from 121 to 108 is normal. It's healthy, and it's probably not over. We could see another test of 100 or even 95 before this consolidation is complete. But unless the support levels fail, this is a correction, not a reversal. And corrections in bull markets are buying opportunities. One final thought before we wrap up. There's a psychological element to this that matters. When silver hit 121, Euphoria was everywhere. Social media was flooded with posts about silver going to 200, 300, 500. Retail investors who had never owned silver were buying. The mainstream media was covering it. That's the hallmark of a short-term top. But euphoria doesn't mean the bull market is over. It means the market needs to reset. It needs to shake out the weak hands. The people who bought at 120 because they saw it on Twitter, the people who have no plan, no conviction. They're the ones who sell at 105 and swear they'll never touch silver again. And that's exactly what's happening now. The flush is in progress. The weak hands are being cleared. And once they're gone, the market can move higher without the weight of scared sellers. This is how bull markets work. They climb a wall of worry. They shake out believers. They punish the late arrivals. And they reward the patient holders who bought when no one cared and who hold through the volatility. Silver went from $30 to $121 in 13 months. That's a 300% move. If you think that move is over because we pulled back 10%, you're not thinking like a long-term investor. You're thinking like a trader. And traders get chopped up in volatile markets. The fundamentals that drove silver from 30 to 121 are still in place. The supply deficit, the industrial demand, the monetary demand, the central bank buying, the China restrictions. None of that changed because the price dropped from 121 to 108. What changed is sentiment. And sentiment is fickle. It swings from greed to fear and back again. The market is designed to make you feel fear at the bottoms and greed at the tops. Your job is to do the opposite. Be greedy when others are fearful. And right now, at 108, people are fearful. So here's the final verdict on whether this is a crash or a healthy pullback. It's a healthy pullback. The data supports it. The volume supports it. The support levels are holding. And the fundamentals haven't broken. Could it turn into a crash? If 99 fails, then 92 fails, then 87 fails, then yes. At that point, we'd have to reassess. But as of right now, January 30th, 2026, the evidence points to consolidation, not collapse. The target is still 150. The timeline is Q2 2026 if the bull case plays out. Maybe Q3 or Q4 if the base case plays out. And if the bear case plays out, we're range bound for months while the market builds the next base. But based on the data I've analyzed, the historical patterns, fundamental drivers, and the technical setup, I'm leaning toward the bull case. Silver is going higher. The pullback to 108 is a gift. And the people who buy this dip are going to look back in 6 months and realize this was the last chance to get in before 150. The choice is yours. You can listen to the bears who are calling for a crash, or you can look at the data, understand the fundamentals, and position accordingly. Silver dumped $12 from 121. That's a fact. Whether it's a crash or a healthy pullback depends on what happens next. And over the next 30 days, we're going to find out. Don't forget to like the video, comment your thoughts down there, and subscribe.